Hello and welcome to Livewire's C-Suite reporting season coverage. I'm Ali Selby and today we are incredibly lucky to be joined by BHP Group's CFO David Lamont for an inside look at the big Australian's latest result, as well as a glimpse of what investors can expect over the coming 12 months. Thank you so much for joining us today, David. Really excited to be speaking with you today.
Great to be with you, Ellie.
You've just released your latest half-year results. Are there any key numbers that you think investors may have missed?
Well, certainly I think the underlying performance of the business was very strong. We saw that our revenue grew 6% and our EBITDA grew by 5%, which underpins the operational performance that we've actually seen. On the revenue side of things, we did see an increase in iron ore prices of around about 21%, and on the copper side of things, we saw prices increase 5%, which are the two main commodities for us moving forward. So very pleased as to how they continue to perform. That did actually lead to a very strong cash flow perspective, 8.9 billion from an operating cash flow perspective, which enabled us to pay out 72 US cents per share as a dividend. Now, for those on the audience that are in Australia, the FX rate still has to be set on the 11th of March, but if we take today, that's about $1.10 that'll actually be paid as a dividend on the 28th of March, and that's the fourth largest interim dividend that we've paid out in the history of BHP.
Okay, you talked about earnings before. They did come in a little bit lower than expected, as did net profit, which fell around 86%. What happened there?
Well, certainly in relation to our underlying performance, Ali, what we did see is that we were slightly ahead of consensus. So back to that dividend that I referred to at 72 cents, that was marginally ahead of where consensus was. In relation to the attributable profit, that was impacted by two exceptional items that we took in the half. One was in relation to our Nickel West business, whereby we did impair those assets following a significant amount of supply growth that you've seen out of Indonesia. And that has resulted in 50% of today's supply market being cash negative. For the half, our nickel business in Western Australia lost $173 million US at the EBITDA line, and that forced us into that impairment situation. Equally, what we did is take an impairment in relation to Samarco. And that was to reflect ongoing negotiations that we have in Brazil to resolve a case that is occurring there around Brazilian authorities. And we did take an increase in our provision to finally look at how we could settle out our ongoing obligations in relation to Renova Foundation and also in relation to the federal prosecutor claim that actually exists in Brazil.
Okay, we'll talk to those two challenges later, but I want to stay with dividends for now. You talked about a 72 US cents per share dividend. That was with a payout ratio of 56%. Does BHP have any capital commitments that could impact its payout ratio over the short to medium term?
So certainly what we have said through our capital allocation framework is that we'll pay a minimum payout of 50%. What we have also said is we need to continue to maintain our operations, so that leads to sustaining capital. And then what we do is we look at the excess cash that we're producing and dedicate that to growth and or further reward to shareholders via additional dividends. Now, what we have called out is over this year, we're looking at spending around about $10 billion on capital expenditure. 4.7 billion was spent in the half just gone. And then moving into the short to medium term, we do see that increasing to around 11 billion. So capital and focusing on growth is certainly part of our overall capital allocation framework. But what we are committed to is also that 50% minimum dividend payout, and we'll balance that excess cash between that growth and further rewarding shareholders through additional dividends.
Okay, underlying EBITDA increased across copper and iron ore over the half compared to a year ago, but it more than halved within BHP's coal division. Which businesses do you believe will contribute to the lion's share of earnings over the coming half?
Well, certainly iron ore is and will remain over the next 12 months and beyond that as a key commodity for us. So again, back to the pricing side of things, we did see that that was up some 21%. On an operational production perspective, we always saw that our iron ore would be a little bit more back end, the second half versus the first half. In the first half, we did have our rail technology project, which is a core growth avenue for us coming online, and that did actually curtail a little bit of our production in the first half. So second half should be stronger on iron ore versus the first half, and that underpins that core part of our business, and that is clearly the growth engine that we still see for the short term.
How sustainable are iron ore prices though from here?
Well, as I said, up 21% half on half. So that's a good demonstration of where we do see the overall iron ore market. Critically, most of that goes into China, and China for the 5th year running will produce over 1 billion tonnes of steel, and that underpins that iron ore pricing. Significantly, I would also call out is that we do see future growth in relation to our iron ore business. So in the short term, we do see that growing to 305 million tonnes from what is around about 290 today. And then ultimately we can see that growing to 330 million tonnes. So it's a core part to the business. And that does help underpin that dividend that we referred to earlier, which does go to the 17 million Australians that actually own either directly or indirectly BHP shares.
I want to talk a little bit more about China. It's the elephant in the room here. How much of an impact does China have on BHP's earnings, and what's your outlook on infrastructure demand from here?
Yeah, so certainly, as I said earlier, iron ore is critical into that steel market in China. What we have seen is that the underlying output of the steel mills in China has again, for the 5th year running, been over 1 billion tonnes. A lot of focus goes into the real estate segment, and if you look back over time, that was around about 35% of the steel demand within China. That's now actually wound back to about 20 to 25%. And what's offset that is growth in infrastructure, machinery, electric vehicles as an example. So the shortfall on the real estate segment has been more than offset by growth in the other parts of the China economy. Now within China, they have announced a number of things to address the real estate segment. We certainly see that as an upside if that does actually translate to new starts. What we have seen in the real estate segment is a shift to more completions, and that does help us in relation to our overall copper position as opposed to the iron ore.
Okay, I want to talk to the writing down of those nickel assets that you mentioned at the start of the interview. What is your outlook on nickel from here, and is nickel still an important commodity for BHP over the long term? So
certainly from a demand perspective, our view of nickel hasn't changed. What has changed is the supply side of the equation. 50%, as I said earlier, of the nickel industry today is actually not making cash. And that's on the back of what was previously the lower grade nickel laterites within Indonesia, now actually being processed through technology differences, which requires a lot of energy, into battery grade. And that is taking a supply surplus into the market, which has resulted in significant falls in relation to the overall nickel prices. Now, we're not immune from that. What we need to do, though, is step back and see what's the best way forward for BHP shareholders in relation to that business. For the half just gone, the nickel business lost $173 million from an EBITDA perspective. So we have to recognise that and look at what is the best way forward for that operation. Now, we're different to a number of other nickel players in Western Australia because we have refining and smelting capacity, not just mines. And that's a fundamental difference. So we need to be cautious around how do we proceed with that business, because if we go into care and maintenance with those refineries and smelters, we need to know how we may be able to bring those back post any care and maintenance period. So that is an assessment that we're doing. We're doing that with a sense of urgency. We're doing that mindful of the fact that there's 3,000 employees in our Western Australian nickel business, and we'll continue to assess that.
Okay, I'm mindful of time, so I'm going to look at the outlook now. You've obviously invested heavily in copper and potash. You took the biggest listed copper play on the ASX in Oz Minerals private. How do you see those businesses growing in the future, and where do you see prices moving over the short term?
So on copper, it's really pleasing the way that the South Australian copper business for us is coming together. So that's bringing the Carrapateena and Prominent Hill assets into our portfolio, bedding that down with Olympic Dam, also recognising that we've made a number of announcements from a resource perspective in relation to Oak Dam and also Olympic Dam Deep. So we certainly see that province today, which is around about 330,000 tonnes, growing to in excess of 500. And that's our focus in relation to that. We think that can create a significant copper basin for Australia within the overall copper supply side of things. When you look at supply more broadly, globally, in relation to copper, we certainly do see that there is a shortage of new supply coming on. And the supply that is being talked about is lower grade, and it's also lower, deeper. And so that creates a different challenge for the industry to actually leverage into. We think with our Escondida operation and also with South Australia Copper that we're well placed to help meet the growing demand that the world's going to need for copper.
Okay, many of your iron ore competitors have been buying up green investments of late, lots of lithium acquisitions. Are there any strategic acquisitions on the horizon for BHP over the coming 12 months?
So let me start by saying lithium isn't something that we see within our portfolio, so we're not looking at that. What I would say to you is we look at all levers for growth for us. I will start with the one that can give the greatest return to shareholders, which is our own backyard and our operational performance. So improving our productivity, getting the most out of the resources we already have is our number one priority. You will have noticed that we spent $4.7 billion in the half on capital and exploration. We have increased our exploration expenditure and looking at principally into copper. 80% of that spend went into the copper side of the portfolio, and to see how we can uncover some additional resources globally. Now that takes some time before that would actually come into the market. We've also got early stage entries where we're partnering with a number of players on early stage opportunities that still need to be proven up, but that's another growth avenue that we actually have. And the final area that we're looking at is certainly around technology. And I'll point here to our Escondida operations, where we're looking at a number of leaching new technologies that could fundamentally change the copper flow sheet for us in Escondida and deliver an enormous amount of value to shareholders. So we're progressing those. Still some time off to actually pick which of those opportunities we will see. But that's partly why we've actually outlined $11 billion moving forward over the medium term for capital and exploration expenditure as we lever into the growth opportunities we have.
In terms of those early stage opportunities that you're partnering with, are there any that you can talk to today that you are particularly excited about?
Look, not so much on the early stage that I'm excited about. A lot of those are confidential arrangements that we have. I will tell you one place that I am certainly very excited about is also our potash business in Canada. And we do see that with Jansen Stage 1 coming into operations in 2026, and we did also announce in the half Jansen Stage 2. And we think this is a really good growth avenue for BHP. As the world has less arable land, it's going to need more fertiliser to actually help feed the growing population that we actually see across the globe.
Okay, well, thank you so much for your time today, David. It was an absolute pleasure and honour to speak with you today. Thank you again.
Thank you, Ali. A pleasure to be with you.
If you enjoyed that interview, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.